Actually, what I'll do initially is I'll welcome the speakers, the panelists to the podium here. But initially, I'd like to thank Therapin for the opportunity to be here presenting today, and thank you for attending this panel. Fábio Figueiredo Carvalho is a co-fundador de Orbe Investimentos. Fábio, please. Bernardo Dantas is the founder of Hedge Investimentos. Pedro Batista is a partner at Vinci. Fábio Dall'Acqua is a director partner at Constellation. Thank you very much, gentlemen, for being here today. Let me just say a few words about us. We are a registered investment advisor with offices in Los Angeles and São Paulo. We have products mostly on the quantitative sphere. We have a Brazil fund, a long-short. The average long exposure being 50%. It is a Delaware fund. We are also opening our exposure to having local funds in Brazil now, being launched shortly. And we tend to favor on our long side exposure to mid and small caps, and our short side exposure to mid caps, but also large caps and futures and derivatives. So that's how we invest with the Brazil exposure that we have. Without further ado, I'd like to pass on to the panelists to explain their firms a little bit and also their strategy vis-a-vis Brazil and how they play small caps, mid caps. Let's start with Fábio from Orbe.
Okay. Good afternoon. Thanks very much for the opportunity and thanks for the interest in Brazil and the alternatives in Brazil. Orbe, my company, is a 10-year-old fund that I've started, and we've been focusing in this particular universe, in this particular section of the market of lesser-known, smaller caps, smaller companies, which we could call mid-caps. There will be some controversy here about what is a mid-cap, what is a small cap, and those definitions, I think those would be a good part of the discussion here. But anyway, in our idea, our approach is to focus on that universe, which is that mid-section of the market of smaller companies, mid-caps, less liquid companies. As I mentioned, my company has been doing that for 10 years. I've been doing this in Brazil for 15 years now. And let's have a good discussion about it.
Thank you. Bernardo?
Hi, my name is Bernardo Dantas. I'm the founder of Hedge Investimentos. And we have one long-only fund. I would say it's an all-cap fund based in the value investing philosophy. I founded the company in 2007 with my partner, Alexandre Martins. And right now, our fund has assets of 37 million reais. And basically, that's the introduction.
Thank you. Pedro Batista?
Good afternoon. My name is Pedro Batista. Vinci, thanks again for the opportunity. Vinci Partners is an investment company. It was founded about 1 year ago. It's controlled by former Pactual Bank partners. Our head partner is Gilberto Sayão, who was a co-controller of Banco Pactual. We have 6.5 billion reais under management, of which around 3 billion reais in public equities. Although we are not pretty much focused on small caps, we do like the asset class, and we have one fund basically dedicated to invest in small caps. Thanks.
Thank you. And Fábio Dall'Acqua from Constellation.
Good afternoon. We at Constellation, we manage two strategies, long only and long and short. We are currently managing 1.6 billion reais, almost well balanced between the two strategies. The company was founded in 1999, 12 years ago, to manage the money of three families, the families that were the controlling shareholders of Banco Garantia, which was one of the largest investment banks in Brazil. We also have an association with a U.S.-based hedge fund called Lone Pine Capital, which owns a proprietary piece of our company. And part of our in the two strategies that we run, the small caps and mid caps play an important role in our strategies. We've been investing in those companies since the beginning, and I'll be able certainly to explain a little bit better during the course of this panel. Thank you.
Thank you very much. So I'd like to start by asking what the definition is that the portfolio managers here use for mid-cap and small-cap in Brazil. I can say that for our long book, or for our book of trades, we normally call a small-cap situation in Brazil as being a company that has a market capitalization of $1 billion or less, and a mid-cap between $1 billion and $10 billion. And on my long book of positions, we have on a capital allocated basis 49% of the book today in mid caps and 30% in small caps. I'd like to know from each one of you where you are in the definition on your long book, please.
Okay, as I said, I think we'll disagree on this definition probably, but I'd say roughly our universe, it's comprised of companies ranging from very small ones to up to 5 billion in market caps. So my small and mid caps will be up to 5 billion. But most of all, I think the most important part of what we do and the strategy that I think where's value in this particular universe, it's not the cap and actually the liquidity of the company, but the fact that those companies, and for many, many reasons, some of them particular to the Brazilian market, some of them are very normal in other markets, but the point is those companies are very underfollowed. So our focus is much more on how underfollowed or under the radar those companies are than actually their cap. So we've invested in companies that were a 6 or 7 billion market cap in the past. So we don't actually restrain ourselves in a very strict form, but we want companies that are underfollowed, under the radar, not on the large indexes. So for us, they need to be out of the index, of the Bovespa, the large important index, and they need to be underfollowed. Usually a few broker reports, so the sell sides are not covering. International investors are still not very present in their floats. So they're usually underfollowed, under the radar, smaller. That's more important for us than actually the strict definition or the strict cap.
Thank you. Bernardo.
Yes. If we look to the small cap index that the Bovespa has, we have, I would say, 55 companies, and the market caps there, is a huge range from 100 million reais market cap to almost 6 or 7 billion reais companies. So for me, this is not small cap. So we have also mid companies there, and as Fabio said, what I think is really important is not the size of the company, but the price that you are paying, and you have to consider the liquidity of the stocks or the company that are investing, and you have to get paid for that liquidity. So basically, that's my opinion, and the most important thing is I would say is the quality of the cheapness of the stock. So small caps usually are underfollowed, or as Fabio mentioned. But we need to focus on the price that you pay and the value that the companies bring to you, and in terms of cash flow and cash flow generation, the long term. That's what how we base our investment decision at Hedge Investimentos.
Okay, at Vinci, we have a definition. We use 5 billion reais market cap as a reference to define a small cap. Although looking on our small cap fund, approximately 90% of the fund is invested in companies with less than 2.5 billion reais market cap. So although we use 5, in practical terms, we end up like the result of the portfolio is in 2.5. We tend to focus on companies, and I do tend to agree with both my colleagues who spoke before me, on companies that are undercovered, and especially on companies where we do believe that we have a competitive advantage. We have an edge to understand the business model, to be closer to management, something where we could differentiate ourselves in understanding and getting comfortable with the position, right? Given the fact that in small caps, your right to make a mistake is not your right is very limited, right? So we do have to, when looking on small cap, we tend to look for companies where we can have an edge in understanding their business models.
We at Constellation, we also use a reference in terms of market capitalization, which is $5 billion for small and mid caps. But we try to focus more in terms of risk factors, the speed of sales. Because you may have a company which has a market cap above $5 billion, and the liquidity of the stock sometimes is smaller than the liquidity of other stocks which has a lower market cap. So controlling the liquidity of the portfolio is much more important than just segregating the portfolio into market capitalizations. Companies are small caps usually for three reasons. Either the business has a low capacity to grow, either the company has a low quality of product and low quality of managing, or companies are startups with a good probability of growth, which are the ones that I'm sure that all of us here want to be invested in. So I think the most important message that I would like to relay to you is, although we have those traditional ways to segregate what is a small cap, particularly in Brazil, where the liquidity of small caps is way lower than the liquidity of small caps in the US, it's very important to have a focus on liquidity and use the liquidity speed as an important risk factor for any portfolio.
Very good. Thank you. I think two of the funds here represented, I believe, ourselves and Constellation also employ short strategies, so we offer long shorts. And I'll speak about us. We don't have enough ability to find names in the small cap and mid cap universe to satisfy our risk reduction needs on the short side. So we do go to large caps. We do go to futures for achieving that, and then we use a quantitative platform for that. So I would say that our utilization of mid cap and small cap on the short side is probably limited to a third or less, sometimes zero. Fabio from Constellation, I'd love to know if you can explain how you manage the short side on the fund that focuses on the mid caps.
Well, first of all, I think one of the biggest challenges we have in shorting in Brazil is less to do with the ability of borrowing stocks, and it's much more to do with the ability to develop fundamental shorts. Please don't get offended what I'm going to say, but if you look at the average quality of the listed stocks in Brazil, the average quality here is higher than the average quality of the listed stocks in the US, simply because we have less companies listed. Only the best companies in our industry is made to the public markets in Brazil. So if you want to short railroad companies, we have just one company. You want to short car rentals, just another one company there. So that's where the challenge poses. At Constellation, when we build the short book, we usually try to have lower concentrations vis-a-vis our long book. Usually the market capitalization of our short book is slightly higher than the long book because of the liquidity of the stocks, and because there is still some constraints in borrowing, and the risk of getting squeezed in shorts in small caps in Brazil is pretty high. So that's a little bit about the profile of the short booking that we have in our funds today. So with higher number of stocks vis-a-vis the long, with a slightly higher market capitalization vis-a-vis the longs. Great.
Yeah, I was chatting with Fabio from Orbe before this panel began, and his point was very interesting, which is that a small cap may not mean a small company. And I wholeheartedly agree that some great companies are out there in the public market in Brazil that simply have low liquidity for various reasons. So I'd like for him to expand on that point for us.
Okay, sure. I think that's important, and it's a particular characteristic of the Brazilian market. Because as Fabio mentioned, the number of listed companies in Brazil is still very, very limited compared to the context of the whole economy in the country. The number of companies that actually reach the market is limited, and that resist and survive in the market is a limited number. It's only the larger players, usually dominant players in their industries. So when you look at the Bovespa and we talk mid caps, it's more than 5 billion or whichever number you want to use to define those mid caps. They are mid caps in the context of Bovespa, where exchange where you have Petrobras and Vale, those gigantic mid capitalization companies. So mid caps and less liquid companies in the Bovespa, they are called that in a context of an exchange where we have Petrobras, Bovespa, the banks, which are giants, absurdly huge companies. So Petrobras trades $1 billion a day. Of course, a company that trades $5-10 million a day in Brazil, for the context of the local large investors and for large international investors, those are very thinly traded companies, and lots of those are small caps, and as I said, underfollowed. But in the context of the economy, those are usually very large companies, very large players, dominant in their industries most of the time, and hence they are taking huge advantage of what's happening in the country. They are in very strong positions. They are not risky business. Sometimes small cap investing and mid cap investing is associated with way more risk than more blue chip names. And I would say in Brazil that's not perfectly true, because in Brazil you can be talking about very dominant and strong players in their industries, very large business in the context of the economy, even though they are smaller caps or less liquid companies in the Bovespa, in the context of the Bovespa, how it is with very concentrated liquidity, giant companies. So usually we invest in companies that they are less liquid, underfollowed, small or mid caps, but they are usually leaders and dominant players in their industries, very good and profitable and strong businesses. So the risk associated with those, the business risk, I'm not talking about daily market risk, daily volatility, I'm talking business risk here, thinking long-term investing, that's what we do, and I think most of us here, what we do practice is a very long-term oriented investment. And for that kind of investment, the business risk of each company that we are buying is the most important thing. The business risk in those companies, they are not, as you would assume, a small cap universe in other countries would be, because those are large companies, the dominant companies in their play field, in their industries in Brazil.
Thank you. I happen to agree with him, but if anybody here disagrees, we need to become more feistier here. So, Bernardo, on the risk management, again, we were talking before the panel. You see small caps out there. You want to go long. You want to hold them. What kind of return you want to see? What kind of premium are you willing to take for the lower liquidity? And how do you manage risk on your portfolio overall?
Yes, that's a good question. And I think when we are looking to the small cap and the issue of liquidity, the investor should, liquidity has value. And when the markets, are too optimistic, I think the investors forget this rule. So I think in the long term also the returns in the small caps are much more based on the price that the small caps are trading. So the valuation, you need to require a discount, a relevant discount. I would say 30, 40, 50% of your idea of intrinsic value. And right now I don't see too much value in the small and mid cap areas in Brazil. I think that the valuations are not that with a relevant discount to give the investors the long term required premium to be invested in liquidity assets. So at the end of the day, it's just valuation. I think there is no size effect or other effect. So it's basically you have to make sure that you are paying a very low price to invest in a company. There is low liquidity, and in terms of risk for a value investor, I would say the risk is not volatility. As a long-term investor, you have to think, as Fabio mentioned, the business risk, the balance sheet risk, or the risk that the company has a strong balance sheet, and we have a downturn or a very tough economy, the company will survive. And the most important one for me is valuation risk. You have to make sure that you are paying a very good price, a bargain to make sure that your downside is very limited on those type of investments.
If there's a stock that does not trade every day, do you still buy it?
Depends. If the discount is because liquidity is also relative, right? My fund is very small. It's I would say like 37 million reais. So for me, liquidity is important, but we manage the liquidity of the fund, of our investments, and we limit our exposure based on the liquidity that the investment has on a daily basis. Our redemption is 30 days, so I have time to divest an investment with without causing too much impact of the price. when you are trading liquidity assets, you have other costs that are not, showing the. You have the bid and ask spread higher. You have the impact price. If you're a big fund and you want to buy a small cap stock with low liquidity, mostly your margin of safety will go out. Only you putting yourself in this stock. So, but we do manage liquidity, and I would say that the lowest. We have companies that traded less than 1 million reais per day, but that's. We manage that pretty close in terms of our redemption period in the fund.
Great. Pedro, we have had the IPO class of 2006 and IPO class of 2007, and not all of those companies have been happy graduates. And now I've heard 1,000 companies are waiting to potentially IPO in the next several years. Is there going to be a crowding out effect because there's only so many of us? Even though more assets will certainly flow to Brazil when that flow reverses. What's your view on the IPOs coming out? There will undoubtedly be mostly mid-caps.
Well, on the IPO side, actually, if not mistaken, if you look from 2004 to now 2011, there were in Brazil roughly 120 IPOs. Out of these 120 IPOs, around 70% of the companies, they are companies with a market cap of less than 5 billion reais. Some of the companies, as you mentioned, provide provided very good results for investors. Some of these companies have not, and given how the IPO books they were on some of the on these transactions they occur. Sometimes they are pretty much concentrated in some very large investors that sometimes as the book runners, right? Sometimes they are running like 3 to 4 IPOs at the same time, and then you have a very hot one, right? And sometimes investors, to be allocated in the very hot one, end up like having to buy a stake at let's say not an interesting price at some of these new names. Let's put it this way, right? This occurred a lot, and of course, as the cycle changes, or if at the first quarter result or second quarter result, these companies do not deliver what the sell sides they were expecting. And given the liquidity, this provides actually very good opportunities for the company to invest in some of these companies, right? A big risk on this kind of, put this way, on newcomers are most of these companies are companies that either companies or sectors that are not well known by us or by the market. So it's still a learning process, but we do see very good opportunities on some of these companies. In fact, if in our small cap fund, most of the return that we have generated since the inception, we were investing in companies that were IPO'd since 2005, and companies like that, right, that were pretty much misunderstood by the market, and that end up providing very good profitability for shareholders. So we do believe that there are very good opportunities in some specific companies. And looking forward, given that most of the newcomers should be companies at around, let's say, 5 billion reais or even less market cap, that might appear very interesting opportunities. And as my colleagues mentioned, some of these companies, or most of the companies, are very well managed. Companies that are prepared to make an IPO, and most of the times they are, they have a very good competitive advantage to local peers or even to foreign peers.
Great, thank you. What I wanted to say is maybe give a firmer tone as to why we're doing this, because I personally really do believe that mid caps and small caps in Brazil are severely undervalued to any global peers. So spending half of my time in the U.S., there's a valuation gap that is dramatic, and so you read about Warren Buffett discovering Brazil now. It's really not surprising. One of the best things that exist in the world is this thing called EWZ, which is the iShares Brazil Fund in the U.S. I don't know if people are familiar with it, but It's sort of our main competitor, and it is essentially Bovespa in the US dollar. It trades in the New York Stock Exchange. And I find it amazing that billions, it is, to my calculation, or the result, it's daily available, $13 billion are in the EWZ right now. And having degrees from Harvard, I can say that, a criticism that I have to Harvard is that they have EWZ as their number one stock ticker, with $200 million in that ticker alone. Now, EWZ being Bovespa means that 20 to 25% of that amount is going to Petrobras and Vale. Now, I love Petrobras and Vale. They're great companies. They're really well run. But Petrobras is a $250 billion market cap company. So when I tell my US investor, it's like investing in Walmart. It's a great company, but is it going to double in 3 years? I don't think so. So to Fabio from Constellation, is there any merit left in investing in an EWZ or large caps for that matter?
Well, this is not an easy question. We at Constellation, we believe that there is a merit in investing in large caps. It requires, a lot of dedication, a lot of in-depth research in looking at those companies. Talking to consultants, talking to customers, suppliers. For commodities, you must dedicate time to travel to China to understand dynamics of supply and demand. We have been able over the years, we've been doing this for 10 years, to find and develop varied perceptions on those companies. Let me give you one example. In 2007, it was a year where several of the mid caps in Brazil didn't perform well. It was a year where most of the commodities were benefiting from the global growth. When you look at the sell side, which is most of the people covering stocks in Brazil, Goldman, Morgan Stanley, Credit Suisse, everybody had a negative bias or neutral bias on CSN, which is one of the largest steel producers in Brazil. We had a total different view there because we were, spending a lot of time in the company and trying to find a variant perception, which we found and we invested, and that was a detrimental investment for our books in 2007. Made us, to outperform the market in 2007, while several value and fundamental investors did not outperform the market on that year. So it is more difficult. There's certainly more alpha, and we certainly generated more alpha over the years in mid caps and small caps. So there is much more beta involved on the large caps. They're much more influenced by the macro elements. But again, I think it's a mistake to ignore totally those companies. One example, as of now, look at Itaú, which is probably one of the best managed banks in the world. It's trading at 9 times earnings next year. The average ROE of Itaú is above 25%, around 25%. A bank which is leveraged, 6 times only. So it provides investors with the double of the return of JP Morgan, which could be a comparable, with half of the risk. And again, it historically has traded around 12 times earnings. So you could argue that you're buying below intrinsic value, that you're buying below average. There is earnings growth. There is high return on equity, and it's a large cap. So ignoring those opportunities, we believe it's a mistake.
Great, thank you. I think we have 5 to 10 minutes. I'd love to open for questions from the audience. And we have one person at least with a microphone. Anybody?
Yep. Anyone got a question for our panel? Okay, got a question at the front.
Alejandro Riqueses from Windmill Capital. I'm going to be tomorrow being where you are, talking about family office and how we invest. One of the easiest things about the ETF for the families that we manage is to enter in the market or to get out of the market. Because sometimes when you invest through funds, you have certain period of times that is good for long-term investor, but sometimes the families want to get out of one country and go to the next one. Wants to go to China or Russia or India, but next year they want to go there because of the increase. Do you see opening new ETF in mid cap and small cap as an opportunity for family office to invest?
It's a question I get all the time. So I think ETFs have a role. We don't believe in a long-only portfolio. We believe in long-short because Brazil is a volatile market. People tend to forget 2008, and I don't think they should. And so I think there will always be a room for a family that gets to the point in which they believe that they should diversify into a long-short product. I think the current offerings do not represent the Brazilian economy. I know the breakdown of EWZ better, but EWZ is 35% natural resources. Brazilian economy is 5% natural resources. So right off the bat, it's not representative. If you have better ETFs out there in the future, perhaps, but I do still believe in active management. Anyone else?
There is one ETF which, honestly, I don't know the criteria in how the composition is made, but got somehow, popular recently about mid caps. It's called BRF. But again, it's I don't know how to judge, the criteria in terms of how a stock goes into the ETF, how a stock goes out in ETF, in the multiples criteria, etc., etc. So again, I still believe that at this point, I would favor for an active management, spending time obviously to find someone that their strategy is aligned with your investment process, that will pick those stocks in Brazil.
Any other questions?
Okay, this is the final question for this panel.
Yes, a lot of discussion revolved around the trade-off between liquidity and the stocks that you're buying. What would you assess as the appropriate risk premium for mid-cap stocks? I mean, specifically in the U.S., when we look at investing in illiquid investments like private equity, we're looking for between a 600 and 700 basis point risk premium. So in your situation, what should be an appropriate risk premium for this segment of the marketplace?
Well, thanks for the question. Basically, I think that this issue on the risk premium, I think that for us depends a lot on the sector, on the sort of earnings volatility we're investing. So, for example, if you're investing in let's say in a small cap, let's say utility, right? Then maybe we could accept like 600 or 800, let's say. Whereas if you are investing in a strong growth retail company where that is investing, for say, in a new format, right? Then of course we would ask for a much higher premium. Not, of course, liquidity has a premium, but we tend to focus pretty much more on the business itself and what kind of a risk, business risk we are buying. So it's our approach for that, right?
Any other questions?
About the liquidity, as you don't use just the small cap and mid cap to control your position, what kind of tool you use to measure your liquidity in your position?
Bernardo, do you want to take that? Or Pedro? Or Fabio?
Yeah, no, I'll do it. It's actually a mix of different tools. It comes from actually managing your investor base, first of all. Your investor base needs to match the kind of assets you're buying, first of all. The kind of investor, the terms you have with those investors, their time horizon for that particular investment. So that's, first of all, it's one thing. I know you're asking probably much more on really tools, quantitative tools, models, what we do. But what we do is actually we try to model a portfolio and to keep track of it and monitor it, comparing it to actually what we have in terms of the investor base, of their horizon, of how diversified, fragmented or not our investor base is or not. I think you need to have a mix. What we do is actually we keep a mix of more liquid stocks, less liquid stocks, and we follow that actually on daily basis, what's been the average trading on each one of those stocks and what's actually our potential redemptions and within which time frame that we have. So it's actually a mix of different tools, but in my opinion, it needs to be very, very focused on your kind of investor base, investor interest in terms of time horizon, the redemption terms you have with those investors, how fragmented or not is your investor base. When you're managing a fund, I think you need to be much more focused on your, let's say, liabilities, actually clients, investors, and then actually managing the portfolio as a mix of different liquidities and keeping close track of how the liquidity on those stocks is evolving. Because actually also in Brazil, liquidity changed a lot over time. We've invested in stocks in the past that when we were buying, it was very tough to buy. They were trading $500,000 a day and things like that. And we built small, easy positions. And then companies start showing better results, start to be better coverage, more analysts following, larger investors investing, and that liquidity just skyrocketed because, as I mentioned, lots of those companies are large businesses. When they start to be followed and they start showing good results, it's very, very easy for a stock in Brazil to actually come from a position of very, very thin, small trade volumes and then move and jump to higher volumes, relatively short periods of time. So we actually keep close track of what's happening in terms of the float of the company. Is the float concentrating or not? So are large investors buying huge chunks of the company? Is the float concentrating or not? Is the float getting more fragmented? So it's a bunch of different tools, but it's probably the most important risk management tool for a fund like ourselves is actually the liquidity risk management and the assets and liability management.
Yeah, just to complement Fabio, at Edge, we look at the monthly liquidity, and we make sure that and then we get the average daily liquidity of the every stock that we invest, and we need to make sure that we can, give the money back to our clients in 30 days. So I would say today, doing 50% of the volume of our stocks, we will liquidate the portfolio in 3 or 5 days. So that's the way we can manage the liquidity issue of our portfolio.
Well, I've gotten the signal that we have to end. Thank you very much for your attention and attendance. I'd like to thank my fellow panelists. And if you have any questions, catch us at the conference. Thank you.
Thank you.